Hey everyone, this is Saksham Mendiratta, founder of Lights Out Studio and partner at Lights Out Venture. Well, I've been onto something incredibly exciting for the past few months. I have met some of the most celebrated entrepreneurs in the country. This actually started with me identifying a gap in the Indian startup ecosystem. You see, even though startups dominated the past decade in our country, we still kept looking back at what Silicon Valley breeds in its culture. I thought it was time to change this. So here I am with an all-new limited edition series where I talk to founders of some of the fastest growing startups in the country. And we ditch the traditional podcasting format that you've known. So sit back, sip that drink as I bring to you In the House. You know, they say that it takes a while to become a seasoned entrepreneur. Well, it's actually quite the same to become a seasoned investor as well. How do you behave as an investor? What do you look for in a startup? Where is it that you pull your cards out? There is so much competition and chaos to back the most incredible founders, and the India growth story has just gone beyond expectation in the past decade. Today, Kanwal and I, we dive into the nuances of what breeds a great investor mindset. Every bit of this conversation is enriched with so much experience that he brings to the table. We fought a couple of times, we battled our way out in ideologies, but I think you would absolutely love every single minute out here. So here I am, in the house with Kanwaljit Singh, founder and managing partner at Fireside Ventures. Check it out. So when an entrepreneur walks into your door, when you have interactions and you see them rise through the journeys, whether or not it's your portfolio or not, is there a way that you feel you would define entrepreneurship?
So I think the common character that I find is some kind of a combination of both a vision and a passion. And then there are nuances of shared experiences or problems that you have personally encountered. So if you just take the high level, almost the motivation for someone to turn entrepreneur, at least my own learning has been that you start with something which you believe passionately in, and something which you believe can in some ways change the world.
Yeah.
Now the scale of that or the scope of that could be like from something which is just around me to something which can be a world beater, but at least the motivation is not that this is one more day of a regular kind of a get up in the morning and go to work. So I find that is really the most exciting aspect of entrepreneurship.
And is it best portrayed when it's born out of a personal experience?
Very often it helps, because then the passion comes from just the shared experience, or from having gone through some, let's say, more personal, experiential, either event or just a journey.
Right.
But if it is purely data analytics and somebody is just
so there are also these people, and now with multiple ventures, concepts coming up, right? There are a lot of these people who've had key strategic positions or have leadership experiences, and they're not the best concept creators, right? They might not be the best 0 to 1 idea founders, but they might be great executionists.
Sure.
Is that also a valid entrepreneurial trait?
Yes and no.
All right.
See, I have seen that sometimes very seasoned senior professionals don't necessarily make good
founders.
Entrepreneurs. Because that 0 to 1 journey is about bootstrapping, is about all in. It's almost like you are willing to bet yourself or bet on yourself at the exclusion of everything else. And two challenges I have seen, and again this is my perspective, there are different models around it, but one is that the mindset of building something from scratch becomes difficult as you grow more into professional lives, both with age, your own financial
the risk
status.
appetite goes down and so
and
on.
it's not the level of risk that you would take when you are in your late 20s or early 30s, which I still feel is a great time to become an entrepreneur. Second is that there is also this, hangover, if I may, of best practice, of past experiences.
Yeah, the sort of baggage that people come with.
So it could become a baggage. I wouldn't say that it is a baggage to start with, but sometimes, you almost feel like, I've been there, I've done that. And the third personal thing for me, because, our whole model of investing, or my personal model of investing, has always been very hands-on. Because to me, the whole idea of being an investor is because I get the, joy and the experience of working with founders. Is sometimes, then that's a connect which becomes much difficult.
Right.
Because, it's almost like saying, I know it all, I'll do it my way, and, I will be polite with you and not engage with you.
No, it's actually a good segue, actually. And so venture capital overall has become, in a way, competitive, right? For good reasons more than the bad ones. There are angel investors, there are VC firms, and I wouldn't go on to PE because they come at a different level. But within venture capital, you've been here for a fairly long time, but and so have a bunch of other funds, but the number of startups coming up have tremendously gone up, right? Do you ever face a bit of a challenge? Because it's a long-term relationship, right? It's not a 1-2 year. You'd be with them in a relationship for like 4, 5, 8, 10 years. Do you find it challenging to place or convince them on your ideology and putting Kanwal first before Fireside?
Actually, I would say we should put neither first. Because the idea of an investor, and again, this has now become cliched because I've said it so many times, we are kingmakers, queen makers. I think you have to buy into the vision and the concept of the founder and then figure out what is the best way to support
But who buys into this concept?
It has to be at an institutional level. It cannot be that I as an individual buy it and everybody else around me is, accepting it because I started the firm. Because eventually the value that we bring to the table is not me. It's an organization, it's an institution. So if people are, not convinced and they are doing it as a lip service because, somebody who was a senior leadership is telling them to do it, it never works. It never works in any environment, forget entrepreneurship. So to that extent, I would say that if you don't believe in the vision and the concept of what the founder is trying to do, then you should not invest, because to say that I will help that person to figure it out, I think is the wrong model for investing. You can help them navigate a few areas, and especially what mistakes not to make, and some of the learnings that you have had, because our whole value is that we bring width.
Right.
So having invested,
whether it's knowledge, expertise.
Absolutely. So it's really about saying, can somebody go deep while we can help with the wider perspective? If that clicks.
And is that enough of a differentiator or a moat as a fund?
Depends on how much you want to really bring on the table and how much you engage. So differentiation will come from how you just engage with the founders.
Right.
See, this value add and all beyond a point is also marketing, right? I mean,
True.
We can talk about a lot of playbooks and models and how we help our companies. But it's really your relationship with the founder when the rubber meets the road, when things don't go the right way. How are you supporting them? So there is a lot of that softer aspect, which actually is sometimes even more valuable.
Right.
In how you engage and how truly you are a partner versus and obviously we still have the governance aspect. We still have the responsibility to our investors to protect their money they have given us. So it's really that balancing act, and that's something which takes a lot of time and experience to build as a system. So
and you also evolve over time, I feel, eventually.
You evolve when you realize the different elements that you need to juggle.
Sure.
Because you can be a very mercenary in a sense, saying, okay, I will invest in 20 companies and 5 will work out, 15 will not work out, and they will shut down. But to me, the big question is, this is not a game of chess, with those plastic pieces on the board. This is individual. This is human beings. This is people who are bringing in passion or bringing in sweat. So you cannot just treat it like a game of strategy. It has to be something which has an emotional angle to it and a connect, and still being able to, be practical about stepping back and saying it's not working. So one of the tough conversations which I think everybody needs to learn is, when do you tell an entrepreneur that something is not working, and either he or she needs to reconsider what they are doing, or even think about shutting it down, or doing something different.
And those are tough conversations.
And those are tough, and those are also conversations which have to be done in an environment of extreme humility and extreme, trust and authenticity.
Sure.
Because otherwise, if you start telling somebody, saying, you have done a bad job, you have lost me my money, and this is, I'm saying I value the entrepreneur's sweat even more than the money that, say, I can provide them.
The ability to start and kickstart a new journey. Sure.
For me, as a portfolio manager, a loss of a company is significantly less impactful than for an entrepreneur who is given his or her entire, life and sweat to it.
Agree. No, that's an interesting perspective, and I've had this experience. So I've personally individually invested in a few, and I've had this experience where as much as you would advise a founder after you've invested, right, on what you should or what you shouldn't, or say when it comes to say sometimes the concept of pre-emptive rounds, right, and founders end up going for it, right? They end up, because capital is also available, they end up taking it. How do you advise founders on pre-emptive rounds and whether they should go for it or not?
It's very contextual, obviously. See, sometimes you are seeing, like I said, the width of the market and the environment, and sometimes you feel that it may be worth, keeping some kind of, eggs nest in the bank, and having that ability to, be able to protect yourself against some negative, headwinds that may be coming. Sometimes you can even visualize opportunities of what else you can do if you have some amount of money in the bank. And then sometimes you are also
wouldn't that diverge focus?
It will, but the good part is that, if you can do it with some method to the madness. See, what I have personally been, seeing as a learning experience, and also over time have, developed some intuition around it, is that as you start establishing the foundations of your business, which is the most difficult part, that 0 to 1 as you called it, you also need to then start bringing in the right people to take it forward.
Yeah, true.
And create space on your calendar as a founder to think of what next. So that is the balancing act which a founder or a CEO or somebody who's providing leadership to the business needs to keep thinking about. Because what is today and what is here and now is your bread and butter. But if you don't plan for 12 or 18 or 24 months down the line, then you can't start it when you hit a point where you say, okay, this thing is now kind of stabilized, now I need to start thinking about it.
Yeah, but I also think that given the competitive environments that today it is, markets are evolving way faster than they used to, say, 5 years back. And it's difficult to even plan what it would look like 24 months down the line, right?
Absolutely.
And in that case, is take what you're getting, a wise mentality is continue to burn at the cost of bottom lines, a reasonable mentality, purely because once you're in the VC world, right, you are focusing on increasing your TAMs and you widening your audience and new geographies and so on, because you're responsible for someone else's money at the end of the day at multiple levels. So is that a wise mentality to continue on with?
So I am not a big believer in that. I personally believe that having an eye on profitability, or at least unit economics, is one key mantra that all entrepreneurs need to think of. And sometimes maybe it is also our fault as VCs who are pushing.
And you take that collectively on the VC world?
I would say that sometimes our agendas are that I have raised a larger fund and I want to put money at a faster pace. And can I direct it? And I have seen examples of that. So certainly, I wouldn't say I'm painting the VC world with a bad brush, but certainly,
no, fair. I mean, it's a more practical brush, I would say.
So I would say that honestly, if you ask me, what you want to do with the money has to be in some sense, based on some foundational logic. So if you say today that I have got a base business that is doing well and I can keep growing it at a certain pace and I have the right unit economics, but I want to launch a new brand, or I want
interesting one,
I want to get into a new geography, or I want to build the next level of team, and that is going to cost me money. I mean, I'm all for it.
It's a rational outcome,
and it's also based on what you are trying to achieve. But if I say that I can acquire customers by giving it free, for example, I mean, to me that doesn't make any sense, because
the product needs to sell on its merit and the growth needs to happen from a business standpoint and not discounting.
Again, that is like a very generalized statement, but broadly what I'm saying is that discounting. So let's put it this way.
Sure.
Procter & Gamble has this very well documented strategy saying create a product which is so good and so differentiated, and then just generate trials at any cost. So they would do sampling of their product at millions of units, because they know that once I have sampled, consumers are going to come back. Now that is a great strategy as long as I have high conviction either through research or through trials. And now with the digital world, you can do a lot of these experiments live. And if you find that for every 10 people who try my product, 2, 3, 4 are coming back on a regular basis, then I'm saying by all means let's really scale up. So point is that interestingly in our world, which is really consumer brands, the whole idea of a J curve exists and it will continue to exist.
Sure.
So the idea being that what does it take for me to build those building blocks which give me the comfort that I can scale this now to a significant level. So whether it's product market fit, whether it's repeat rates, whether it's the cost of acquisition, consumers' response to my product, and a lot of this now digitally can be understood and solved for both faster and with a lot of experimentation in market.
Right.
So what's happening is that this curve is shortening.
It is.
So what would take 2 years is now happening in 6 months.
That's the power of digitization, essentially.
Exactly. But it is not zero. And what we have to continue.
Neither on cost or on time.
Absolutely. And more importantly, there is no shortcut to it except for being practiced. That's where, say, our value will be arrived, where we are saying here is how you can do it so that you can get results in 3 to 6 months. And don't take 9 months, 12 months, 1 year to figure it out. But if you say, I don't even care, I have got something, I believe in it, or I tested it with 5 of my friends and it was all a good positive. Now I'm going to spend $10 million and I'm going to get it to 100 million people. I mean, that model to me is still.
So there needs to be a certain. I agree. There's also, has there ever been, and I'm sure actually, the roadmap or the decision making of businesses has changed after investments for multiple reasons, right? It could be market dynamics, it could be competition, it could be product feedback, and so on. But the decision making stance has changed, the goalpost has changed. Has that ever happened? And if yes, how do you typically react to it? Because it's their business, it's the decision making is still a founder's.
Sure. So it has to change. So it's not that, so why are you raising money if fundamentally you don't have a plan which can change gears or change traction?
Interesting.
So one aspect of raising money, which is really at the early stage, is to establish product market fit.
Correct.
But once you have that, then you're raising money to then put those building blocks and put those accelerators into place, which will help you to go to the next level. Now the question is that, does it change rationally? Does it change with a method to the overall thing, or does it change saying now I have money in the bank and I'll give you a simple example, like at a Fireside fundamental model of investing. Our belief is that the first check should not be a very large check. So therefore while we do try to balance between ownership and between the amount of money we invest, our point is that money is the most important check that an entrepreneur is going to receive to establish that core foundations or product market fit of the business. And that's where we also come in most high touch. So if you imagine any of our companies that we have invested in, that first 6 to 12 months is extremely experimentative, is extremely driven by what are those elements which we will identify as success drivers. So the J curve or whatever that, the start of the slope. Once you have that, then I'm saying it's also imperative that you leverage it. Because if tomorrow you say that, oh, I have figured it out, but I am still going to do it, one step at a time, then you're also being, almost, over conservative.
Yeah.
So when do you go aggressive and when do you go more, conservative is another, skill that as an entrepreneur you have to learn, hopefully with people like us who can be mentors to learn that skill.
Sure.
We cannot tell you, okay, today you do this or tomorrow you do that.
Yeah.
But at least the guardrails and the roadmaps we can talk through.
Yeah. Have you ever had an instance where you've been very interested in a business, but it pushes you to become indisciplined at the valuation at which they're coming, right? You may have a certain thesis, but you like the business, and if you do, would you consider moving upward or forward, based on how the market is responding, or would you stay disciplined in investing?
So honestly, if I take experience of what we are doing, I would say we have been by and large very disciplined about this. So
and it's tough.
It's tough, if you train yourself and if you have had the kind of, scars of learnings over the last 20 years,
right,
it becomes easier because, it's tough when you are young and you are, excited about what you are seeing and you're almost saying, listen, this is the next thing since sliced bread, which is going to change the world and, I want to participate. But I must also admit that you can do the same thing within a certain range, because there is a value for the kind of founders, there is a value for the kind of business they are in. So there are aspects which will allow you to look at a valuation range rather than saying, okay, this is the formula and X multiplied by Y has to be the answer.
True.
But once you cross that formula, I think, or you cross that range, I think that is where the discipline comes in, because there are companies where you feel good about. We actually met a few companies like that.
Yeah, I'm sure. Yeah.
And suddenly they say, oh, but I am getting this offer from somebody else,
right,
2 times more than what you are willing to pay.
Right.
So I will be willing to go up to a stretch from my. So it's not, rather than saying in a very simplistic way, instead of saying I will go 10% below the offer in the market, I'll say I can go 10% above my offer.
Sure.
The gap may still be 80%.
Yeah, but I also feel it's also a slightly thought through way of looking at which investors you want to bring in on board, right? Like there also has to be a little bit of method to that side of the story, rather than bringing in anyone as an investor. I also feel founders have their preferences, their choices, and that also drives them towards the investors rather than the investors just pitching on or just being comfortable with the valuation.
See, our biggest, I would say, call it brand, call it goodwill in the market, is probably the fact that we are seeing almost all the companies that are getting funded in our space at the stage we are in. So we try to do a market check of what that is, what is the cohort of companies that got funded, which we would have also liked to fund.
Right.
And I think we are in a almost 90+%, we saw it kind of a situation. But equally importantly, there are companies who we have met where they are willing to work with us at more reasonable valuations. So we don't try to squeeze them because we have some advantage over that. But you also must realize that at the stage that we come in, for the founders, it is critical that they have a partner who can help them get to that next level of not only growth but also that foundation. Because if you get that piece right, then the positive curve, that inflection point kicks in.
Right.
And we have now started seeing companies where we have come in, say, less than 2 years ago, in a 6 to 8, 10 crore annualized run rate, who are likely to hit 100 crores this year. And it's not one, it's multiple of them.
Yeah, I think that time is also reducing. The customers are reacting much favorably, faster.
Absolutely.
And companies are able to capitalize on it.
Absolutely, and without being silly about it.
True.
I think that is an important point that one has to also acknowledge, that you can do it still with some method to the madness. You can still do it with some more strategic approach. Then the only answer is, let me just throw
I also think there's a little role, not massively, there's a little role for the market to play in this, because if you typically look at the past 2 years, the horizon that you mentioned, There is this mid segment of companies that have come in, which earlier used to be at a tier of the HULs and the PNGs, right? For what is the end game for DTC?
Sure.
Right? So you would possibly get acquired, you would go international and so on, and that's far ahead in your journey. But today there are these segments in between that have come in that are looking at the 100 CR annualized run rate for an acquisition,
sure.
Right? Because for them the moat is new market segments, newer products and so on and so forth. I feel that's also been a reason why founders or DTC businesses have accelerated themselves to reach that goalpost faster.
Actually, I would even go to the extent of saying that we have been extremely fortunate in a situation which actually was a humanitarian crisis to have had this situation where the whole digital brands or digital native brands suddenly come mainstream. So COVID was a huge factor. I mean, and we have to be honest about it that, we just got into this space just before COVID, and it actually accelerated the whole adoption of digital consumption. Second thing that has happened, which is not like talked about in this context, but the entire ecosystem of the infrastructure, all these unicorns that are getting formed, almost half of them are either new age e-commerce businesses. You suddenly have the quick commerces, you have the social commerce, you have the vertical commerce, payment companies, delivery company, warehousing company, logistics companies. Now all of that is infrastructure on which the brands are riding.
Enablements, yeah.
So therefore, for a digital brand today, if I can offer 24-hour delivery to all the key pin codes in the country in 48 hours, I am almost competing with an Amazon as a D2C brand.
Yeah.
And then I'm also on Amazon, and then I'm also on the quick commerce platform. So not only is COVID one factor, it's also this infrastructure that has developed. Another factor which is causing a significant amount of positive tailwind behind these digital brands that are coming out. And then of course the consumer has been more and more excited and keen to consume new age brands. So it's almost like it's almost a point of in time in the history of this country where you have so many positive factors starting to
progression of digital economy is much faster. But I have a slightly tangential perspective and sort of curious to know your thoughts, right? I feel the next year and within the next year, consumers would start to face something called as e-commerce fatigue.
Sure.
Right? As much as they would have relied on an Amazon, it'll continue to thrive because it's a one single shop for multiple brands.
Sure.
And the vendetta with which independent startups or brands are coming up is, I want more control on my customer, and hence I would push them to buy from my own site or my own app. As much as that's great for the business in the short run, with competition increasing, would customers really be willing to shop for every single product on individual sites, or would aggregator platforms still take the precedence?
Sure. Honestly, as a brand, investor, or if you see it from the lens of the consumer brands, it shouldn't matter. So ultimately, again, this is training from levers 20 years ago.
Yeah.
If you have a great value proposition, which you are fulfilling with a great product come service come solution, you need to get that brand as a strong connect with the consumer.
But would it really drive sales? And I'm just bringing a contrarian perspective. Would it really drive sales from an e-commerce standpoint as much as I love the brand, or would I still prefer to buy it on an aggregator platform where I can get 10 other of my favorite brands?
No, which is exactly my point, that it doesn't matter. See, if I want a boat speaker,
right,
or if I want a yoga bar, protein bar, then I'm saying I'm looking for it on wherever it's the most convenient way for me to consume it.
Yeah.
So then whether it's Amazon, whether it's Big Basket, whether it's Swiggy, Instamart, whether it's my own website, or it's a local retailer, all of that becomes a reference set. But if I am saying I want to buy a protein bar, then I would go to an Amazon where I will look for all the choices that are there. So it's really a question of, am I looking to buy a product or a brand?
Yeah, true.
And that is where a lot of the entrepreneurs today probably also need to understand the distinction between a product and a brand.
Yeah.
Because eventually the fact that there are 10 protein bars will become 20 is a given.
Yeah.
So how do I create that consumer connect, the consumer love, and the ability? And what also happens is that there is no rocket science innovation in the product formulations.
Yeah.
So you can have a positioning or an insight to the consumer which is very unique.
So it's a brand play?
It has to be a brand play. But brand without the right product, it doesn't work.
It has to be complementary.
So getting the product story and getting the product right has to be table stakes. I mean, you can't do anything unless you have a great product.
Right.
But that is not enough. And that is really why, whether you are a multi-channel, omni-channel, what kind of engagement you have with consumers, content commerce, solution approach to business, everything comes into that whole thing saying, what is my value proposition to the consumer and why he or she will continue to, buy my product.
And do you think VCs keep up with, because also there is experiential learning, over multiple years. Do you think venture capital firms, and not just Fireside, the ecosystem overall, keeps up as fast as the evolving trends of the market?
I think the effort is to keep up. It's really a question of honestly, what are your motivators? So what drives us at Fireside is that because we chose to be, as we call it, thematic. Therefore, everybody in the system has the same motivation.
Yeah.
And what we are trying to do is institutionally build that muscle internally, saying, okay, if I have to keep up with trends, then how do I ensure that there is accountability and responsibility across the organization on who is looking at what kind of areas and what kind of focuses, and not just trends in terms of sectors. But trends in terms of, like you called it, the enablers.
Yeah.
Like today, everybody is talking of creator economy. Everybody is talking of Web3. Everybody is talking of NFTs and the metaverse.
Yeah.
Now, what is that? It needs some understanding and some deep dive.
I was actually going to get to that, but absolutely.
Yeah. So honestly, short answer is we still don't know. But the more important answer is that if we don't figure it out, then we have the risk of being left behind. And I think what is very important, and something that I have learned like over at least these 20 years of my investing, is it cannot be an individual excellence. You need to have people who understand these things deeply, but you have to have it in a way that it can be institutionally, shared as a learning.
No, you're right. Okay, but let me put this in context of an example, and let's see if we can tackle it from there, right? As an institutional fund, would you consider carving a certain percentage of your fund for new emerging upcoming sectors where you don't have the experience because they're as new as the past 6 months to a year? Would you consider that as an ideology? And I'm not asking this as a Fireside, as an individual investor.
I think you should. Again, the key word that I keep using is have some guardrails.
Yeah.
Have some frameworks within which you should experiment.
Right.
Because for one, if you don't experiment, then there is always the risk of you being left behind.
Absolutely.
And for two, it's also something which, as an organization, you have to build almost as a culture.
Yeah.
So sometimes learning it the hard way is as important to build the culture and build the risk taking. Our business, I keep telling myself and my team and the world in general is, eventually we are in the business of risk taking.
Yeah.
So how do we then, not become collaborative, collective decision makers and still be willing to back our judgment intuition? I mean, my best deals have been where I have almost signed up to do a deal personally. I mean, not through Fireside, on a phone call. Now you can argue that that is being extremely maverick.
Sure.
But on the other hand, the intuition is something which.
But was this on the tail end of your experience spectrum, or was it right at the beginning?
No, certainly at the later half of it. So, but I'm saying that if you don't encourage all our younger team members to follow their instinct, and then find ways of backing them, they will not develop that muscle.
Yeah. But I also think as an individual, you'll have far lesser guardrails as you would as an institution, and hence the ability to take risks.
But I would say that if my intuition is strong about something,
sure,
then I look for what are the points of failure.
Yeah.
Then I look for what could go wrong. Yeah. But I would still take the risk of backing my intuition in a significant way.
Yeah, I have this example that I typically use, right, or this context that if I'm very wowed by the first conversation with the founder from an investment standpoint, I would decide to invest, right? But that would be 80% of my decision. But I would use the rest 20 the next few days just to validate that judgment and see if there are any points that stand out negatively. But if not, then let's just go with it. Like, give them the benefit of doubt in most cases than the others.
Absolutely.
Right. And you spoke about being collaborative. Do you think, and I draw parallels with the venture capital world in the US, right? And I happen to have worked with a couple of them, right, from what we do. It's far more progressively collaborative, right? For them, the deal, the idea, meritocracy is far higher than who backs them. Is that the case in India, do you think, or it's still fiercely competitive? Do two funds end up collaborating on a deal for the benefit of, say, the idea or the founder?
Actually, see, the collaborative part has been fairly well established in India. So to be honest, if you see the history of last, say, 15, 20 years of investing, most funds have their own cohorts of other funds that they like to work with. It could be a peer-to-peer cohort where you say, okay, I will do deals together with you. Or quite often it is about working with a slightly larger investor in partnership, saying, okay, my initial deals, I will do the heavy lifting, and then you come in and then you take over.
Correct.
And some of the most successful outcomes have happened when these kind of partnerships
synergies have come in,
or synergies have been built up.
So
I don't think this is something alien to India.
Right.
It's just that the VC ecosystem is still very nascent.
It is.
So I mean,
why do you say that?
I think we are seeing some really interesting new outcomes today, after a 20-year kind of incubation. Because one of the big, challenges that global investors have always had with India is that, markups happen faster than exits.
True.
So actual return of money is still, only in the last few years we have started seeing, with the IPOs and some big exits happening. So I would still argue that, there is still a lot more room for creating more institutional investing and encouraging entrepreneurship at the next level of scale. And in our space, if you deep dive into the consumer brand space, it is literally the starting point. Because today you see there are hardly any dedicated funds like ours. There are just a few of them.
True.
And even for the investors who are investing from larger funds into our space, the total money going here is still relatively small. So then, to create that positive spiral, to have more, encouragement of more entrepreneurship and so on and so forth. Interestingly, what is happening, which is quite exciting for us, there's a lot of domestic money which has started coming in.
True.
And that is a huge positive sign as far as we are concerned. Not only
was it always there, or has it now risen to the surface?
Last 5 years has been, from the first fund we raised till the new fund that we are raising, it's a massive difference. It's a massive difference. So two things happen, right? One is you are creating a very positive spiral, where domestic money goes in, creates success, creates wealth, and those entrepreneurs, what we are also finding is that their own inclination, once they have that kind of money at their disposal, is obviously to invest it back in the same system.
Right.
Because that's what they understand best.
Right. So there's been a maturity of the middle layer, I feel, which has come in, and because of which the capital has been available within India rather than going outside.
Yeah. But the good part of that is that is encouraging, this positive spiral. If you see economies where this has worked beautifully, of course, US being one of them, but say Israel and some of the other markets. If we can get this kind of a momentum, which may take 10 years, 20 years, but I mean, we don't have a time limit to prove it.
And it might be faster.
It's already happening. So I'm not even saying this is a futuristic thought.
True.
But the fact of the matter is that if you can show success, and then I think the question you were asked sometime earlier, is about the fact that companies are getting built faster.
Yeah.
They are not getting built to be sold at 100 crores.
Yeah.
See, the mindset of entrepreneurs today is, can I build a company which I can run as a listed company?
True.
And that changes the perspective completely. You're thinking long term.
Yeah.
You're thinking organization.
Yeah.
You're not thinking quick flips.
Yeah.
So initially, you know, that excitement of saying, oh, in 5 years I'll build 100 crores, sell it to some large strategic and I'll make some money, is being replaced by saying, can I build to last?
Yeah, because I also feel that you spoke about playbooks. I think those success playbooks are now available for them to see in India itself rather than go outside.
Absolutely.
Right. So companies have actually completed their journey to IPO, or rather begun their journey with an IPO. And those pathways are available for people to sort of look back on and say what worked for them.
See, pathways are available, infrastructure is getting better,
True.
capital is becoming more available, market is becoming more responsive to these kind of businesses. I mean, take Manevar as an example. I mean, what a wonderful success.
Yeah.
I mean, the company which is, you know, doing something very interesting in a category which is fairly, you know, traditional and fairly, I would say, competitive.
Yeah.
They have created a niche, they have used technology in a very interesting way, and they are valued at, you know, almost SaaS levels of multiples.
Yeah, yeah.
So there is certainly, you know, some charm and some excitement to the space.
Yeah.
And again, the virtuous cycle then starts when more entrepreneurs start coming in, you know, they bring in more quality of thought, they start disrupting things. And what technology is doing is, it is also disrupting business models.
Yeah.
See, what happened in the initial, say, part of this whole digital commerce was it was disrupting channels.
True.
So online became via media, it became easy to access global, national markets and so on. But today you are seeing solutions, you are seeing content commerce, you are seeing community-based commerce. You are seeing models which are going beyond just selling products, but selling solutions.
Yeah.
So those are the kind of things which are still, I would say, very early in their evolution.
And the adoption is far higher than how it would have been before, with innovative models.
And faster.
Yeah. And so I feel these are some things that you would say start putting in terms of how the entrepreneurial or the VC world has changed in its outlook, right, over the past 5 years. Are there some things that typically stand out for you? Let's say when you look at the past 5 years, that these are things that have changed, and they've changed me individually of how I look at investments or businesses.
See, I think the whole narrative around disrupting the status quo in consumer brands is really a last 5-year phenomenon. Technology and consumer tech, and, you know, what we had done for 15 years in my experience at Helion and at Carlyle, was obviously doing the same thing in a much bigger scale. Better. I think the reflection of that in how do you build very exciting, sustainable, long-term brands is really a last 5-year phenomenon.
True.
And the good part is that it is just the tip of the iceberg. So that is one, I would say, you know, major, you know, realization, because, you know, I started Fireside more on a hypothesis. I mean, there was very little proof points to say that, you know, you can build exciting brand digitally. And global examples were all D2C, which India may not even be that relevant to do 100% D2C.
Yeah,
there's so much headroom for growth on the overall space.
Yeah.
Second thing that has happened is that the vectors of growth, even in this space, have opened up exponentially. So COVID, of course, was a big help. The infrastructure we talked about, you know, the opportunity of going into small town India, Indian brands going global.
Yeah.
So there are so many, you know, possible ways. Then the models of house of brands and, you know, creating platform plays, you know, then bringing in content-based commerce. So what has really changed in my mind is the scale and the scope of what is possible.
Yeah.
And once you get into that mindset, then I think it's a very positive, you know, almost like a spin on it.
Yeah.
Because we are now seeing, you know, hundreds of companies every month. And that shows that the groundswell is building up.
Do you ever feel the fear of missing out?
You know, you have to get, I wouldn't say get used to it, you have to be willing to accept it.
Be comfortable around it.
Yeah, because, you know, let's put it this way, we do typically 7 to 8 deals a year.
Yeah. Yeah.
And, you know, as long as we are, you know, comfortable in our skin that, you know, that's the pace we want to follow. Now, there are funds which have done 20 deals in the last 1 year.
Yeah.
Now we don't want to do 20 deals, because we follow a certain process. Like you said, there's a certain discipline, there's a certain way of doing it, and not to say that we don't want to be competitive.
Right.
But if we like a company, can we do our entire diligence in a faster time frame and be willing to take a call in a couple of weeks?
Yeah.
Absolutely.
Yeah.
But should we say, oh, we like this, and somebody, people have called us and said, we love you guys, here is our pitch, but you tell us by tomorrow morning.
Yeah.
Something like that, I don't think is our DNA.
Right.
So in that sense, it's either you can call it fear of missing out, but you can also call it, willing to.
And you feel that going
course.
away in some cases, like because there is a process, there is a discipline to it. Do you feel it going away in some cases?
Going as in?
As in, if you are unable to say close and there is competition around, right, within a very short span of time, do you feel that I wish I could, but I'm bound by a certain
no, I don't
institutional
think so.
framework?
I don't think so. I don't think so. I think if somebody is so bent upon a decision in 24 hours, see, what you have to also try to anticipate is how the entrepreneur or the founder will behave in certain circumstances.
Yeah.
So if somebody is saying, I am so excited or so obsessed with, taking the highest value and taking a call in 24 hours, there are also those little bit of, red flags that, come out in your head saying, how is the person going to behave?
Yeah. Once, if this was to materialize. Yeah, true.
Now, I'm not trying to, oversimplify it.
No, true.
But, to me, if somebody is, obviously if somebody says, listen, I have a term sheet in hand and I need to, take a call, but I really want to work with you, and therefore, how fast can you help me take a decision? I like that approach than saying, listen, tell me by tomorrow morning, because then at least it gives me the ability to calibrate, whether we are keen to put, because there is a lot of effort which will go in evaluating a deal, and if we have to accelerate it, we have to pull every resource.
Yeah.
But we don't want to miss a good deal either.
Yeah.
So we will be willing to do that, but not with a gun on our head.
True. Interesting. I like the analogy. Shark Tank has given or opened up the concept of smart capital, because if a shark has 20 investments, they also have the network to open the right doors faster. Right? So
no, it does.
That's coming and being leveraged in India really well now.
See, if they can, in the second season, maybe too early, but take some companies which got funded in season 1 and showcase some success stories there.
Earlier, you're right, but ho sakta hai.
But I'm saying that could be very interesting.
What is the change that's going to hit the economy from a venture funding standpoint in the next year or so, and why is there so much speculation around it?
See, honestly, the fundamentals don't change. I personally don't see any reason why there should be any dramatic change.
I agree, yeah.
So investing as a almost like a class of whatever you want to call it, business or industry, is here to stay. I mean, there's no question about that. Now, what is the speculation is the valuations and the IPOs of companies and all of that. To me, that is a completely different part of this game, which at the heart of it doesn't affect early stage investors like us. So as long as we are disciplined, as long as our business model allows us to do things in a certain way and with the discipline that we have, I still feel that that is far more important.
But are we heading towards a consolidation or a slump in any way?
I don't think slump, certainly I don't think.
Sure.
I do believe that some corrections are due and they have happened and they will continue to moderate. Because the euphoria of companies getting listed where the average investor didn't even understand how to evaluate them gave them a little bit of this FOMO kind of a status, and people have now realized, I believe even the regulators have realized that the benchmarks on which to evaluate some of these companies need to be understood better. So there is almost like a desire to learn and educate the entire ecosystem on how to evaluate these companies. So I think that is a very fair, I would say, outcome, and will have certainly some impact on the kind of valuation and the expectations. But the fundamentals are the same. I mean, this is a large consuming economy. It's growing at a certain pace. It's going to grow to a even larger, consumption economy.
No, I agree. I don't think there's a reason for that to happen. And you're right. Corrections should have happened, and they have. And those X's that we were playing in for valuation should certainly be corrected, simply because there should be enough room for growth and progress moving forward. It shouldn't be purely based on how bullish the market is. It should also be based on the merit of where the product is, where the founder is, where the growth is, where our customers are. So sure, that correction is essential, but I mean, I feel that there's a bit of a euphoria around how there's funding drying up and so on, and I feel that it's.
So I don't think it's drying up. I mean, honestly, I don't think it's drying up. There are more funds which are investing in India. There's a larger, also, like we talked about earlier, there is also a groundswell of more domestic money coming into the economy.
True.
And that is, in some sense,
I think that will continue and be on the rise.
And I feel that is a great balancing act for any international money which is looking at India in a very opportunistic way, saying come in and go out, and keep looking at different geographies as the model of evaluating opportunity. I think that is getting balanced more and more. We have seen that in the mutual fund industry. We have seen that in the larger financial institutional investing side of things. I think in venture something similar will happen, and hopefully in the next, say, 5 to 10 years, if that pool of capital becomes the balancing act, then your dependence on money coming in and out, and therefore disrupting the overall availability of capital, also will get a little bit more stable. Which is a good thing.
No, correct. And I also feel with more maturity in the product market fits over the next 5 years, right, based on new trends established, it'll also become slightly easier to evaluate what will work and what will not, because there's a lot of disruption that did happen, new sectors, emerging trends, and there was monetization to capitalize on that. Now both sides of the spectrum will see a little bit of, say, discipline, maturity. You would know what's worked, you would know what's not worked, and then even innovation bets would be slightly easier.
That's the natural progression. And I think every sector, every new space, venture capital has to invest in forward-leaning trends, right?
Absolutely.
It cannot be rear-view driving. So the minute you get into that mindset, you are going to take risks, you are going to back companies which are a thing. As long as there is a certain method to the madness, it does help in creating higher predictability of success. Now in our business, that's the mantra of what we believe in.
Right.
Saying we want 50, 60, 70% of our companies to be successful. And successful, I mean give returns in the 5x, 10x range.
Right.
And then by definition, by the business we are in, there will be those 20, 30% or 2 out of 10 outliers who will do phenomenally well.
Correct.
And that then makes it a very interesting investment model.
Right.
So while everybody talks of Mamaearth and Board, we forget that there are another 6-8 companies in the portfolio in the first fund which are doing really well.
Right.
And that is really to us more important, and where the discipline comes in, the process comes in, where you're saying that what will make it a repeatable success.
Right.
And whether it's the way we invest across multiple stages, how we work with the company, the 0 to 1, I think all of that, if you can institutionalize, then you are creating.
I would say productize.
Maybe whatever you want to, it's a terminology part of it, but I'm saying the format has to be something which you believe, and more success you see with it, the more confidence you get that this is working well, and therefore you can scale it up. I think that's really the underlying, I would say, so individual brilliance coupled with institutional process can create something
amazing.
Very
I like
interesting.
That. I like that. No, interesting. Just a little insight into who you are as an individual. Would you be comfortable, and feel free to deny this, would you be comfortable saying if there were 2 or 3 brands you wish you'd invested in?
There are brands that I have really enjoyed seeing how they have built out.
Sure.
And in terms of, from my early days of Ilion, we looked at brands like Wildcraft, for example. That was a very interesting company, and for various reasons we couldn't.
Right.
We couldn't invest in that. So I think that's one area as a space I find very fascinating, and they built a great company. So I would say that is a good example. We saw this company called Atomberg, which again we had some internal reservations which we didn't invest, but again it's successful. So I would not even say success alone as the reason to feel bad about it, just that you felt good about something and then for some reasons you could not invest.
Right.
But I mean it's not, especially in the consumer brand space, there are not that many, I would say, companies that I would say
which you would categorize under misses
or big regrets. Misses, so there are enough. But because like I said, as long as you are comfortable in your skin that this is the scope of what you are doing,
right,
and you continue to build on that.
Right. And one last bit, right? How do you keep yourself nourished with knowledge? Are you a voracious reader? Do you listen to podcasts? And if yes, could you give us a couple?
So honestly, neither of the two. I am actually far more into just conversations. So the idea is that if you can
meet
the right people and have these conversations, and what I'm finding also very enriching is a lot of conversation internally with our team, because by and large, I would be significantly older in age than most of them.
Right.
And that, then allows me to, have fresh perspectives and, talk to people who are really, like every, call it whatever, the millennial, the Gen Z, the Gen Alpha, you have little bit of representation of almost everything.
Yeah.
So it's really about more conversations than so much of serious reading or podcast. Yeah.